Hello friends, I'm back with a new video, and today the topic of discussion is excise tax. Okay, excise tax is what it is, a tax which is paid to the government, by the producers. Okay, by the producers and not by the buyers. Okay, so excise tax is a tax which is paid by the producers to the government and not by the buyers. Okay, so definitely we will be discussing today about this excise tax. We will be doing the diagrams, and I will be explaining you certain points that how it works in a perfectly competitive market. So in my next few videos I will be discussing few types of taxes. One is the excise tax today, which we are discussing. Next we will be discussing the ad valorem tax, then the lump sum tax are there, and all these taxes will be applied in a competitive market. Okay, so which would be comprising of a farm. I will be drawing a farm and I will be drawing an industry and show the relationship. So now, what is this excise tax? The tax is paid to the government by the producer rather than to the by the buyer. We also assume, now we need to keep in mind few assumptions while we are doing this excise tax. So what are the assumptions which we need to keep it in mind? The first thing is that we assume a constant cost industry. Okay, so the first assumption is we assume a constant cost industry. So changes in the total industry output do not affect the technology or factor of production. Next, the assumption is that all the firms in the industry are identical. Firms in the industry are identical. Okay, and the third assumption is that there are n not number of firms. Okay, so these are the certain assumptions which you need to keep it in mind while we are discussing this topic of excise tax. Now I will be drawing the diagram and I will be explaining you step by step that what are the things which is happening in the market. First of all, we will divide the market into two periods. One is the short run period and in the long run. So what are the effects which we have in the short run and which we have in the long run? So these are the graphs I am going to show you. This is definitely the farm and this is the industry. Okay, industry, the quantity is denoted by capital Q, farm quantity is denoted by small q. This is O, this is P, and this one is for industry. We have for farm we have P is equals to, we will have MR, we will also show SSC and SMC, but here only the price. So first I will be taking a point. Suppose P naught is a point I am taking. Okay, it's P naught. So definitely here P naught is equals to MR naught. Okay, and for here this is the P naught. So from P naught we have an SSC and the this is the SSC which we have from P naught. This is SSC naught. Guys, got it? And from here, so this is the minimum point, isn't it? So over here I have this SMC curve, SMC naught. Okay, so this is the short run equilibrium portion where the firm is having, this is the SSC and this is the SMC. Now we have a demand curve like this. I can draw a demand curve like this, isn't it? This is a demand curve. Okay, with respect to the demand curve, this is the point. So this is the equilibrium point. So from here we have the first supply curve, that is S naught for N naught firms. Remember, this is farm, this is industry. Many farms together form the industry. How many farms are forming? N naught farms are forming the industry over here. This is the demand, which is D dash. The quantity which is produced is Q naught. Actually for industry, what will be the output? For industry the output is N naught Q naught, and for farm the output is only Q naught. Try and understand the differences. This is industry, so we have this N naught into Q naught, and this is just the firm, so the output is only Q naught. You guys got it? Now, so if let us analyze the thing. So first of all, what do we have? The initial we had, suppose I will be showing you two situations. Okay, the first is before imposing tax. This is after imposing tax. Before imposing tax, what was my cost? Cost was equals to C as a function of Q, right? Now, if this is cost, what is average cost? It's C as a function of Q by Q, isn't it? So this is my average cost. And what is my pre-tax marginal cost? My pre-tax marginal cost is del C CQ by del Q, which can be denoted as C dash. Very clear about this. This is the pre-tax situation. Now, post-tax situation. What is my post-tax cost? C as a function of Q plus small t into Q. Remember, this is excise tax. So with output, the tax will be charged for every units of output. Okay, for every particular unit of output, per unit of production, the tax is being charged. So what is the AC? AC is CQ by Q plus TQ by Q, which comes to what? What is this? This is ACT. This is CT. Okay, after imposing tax. So this is one nothing but AC plus T. And what is MCT? It is C dash. So C dash T. This is MCT. You guys got it? So this is about the pre-tax situation. This is the post-tax situation. Now on the graph, if you guys see, we have this is the equilibrium position, and the equilibrium position can be here denoted as, wait, let me rub this thing, it will be better for you guys. This is the E naught. Okay, this is the E naught. Now what is happening is that, because here what happens is that see, the price is now, so over here it is the price was P naught, right? And the P naught was equals to MR naught. Now when the tax is imposed, what will happen? When the tax is imposed, the price of the product will definitely increase. Tax imposition, so this SSC will actually shift upwards. The SSC shifts upward like this, having the same output. Will definitely maintain the same output. Okay, so we get another over as the tax is been imposed, SSC T. So keep it in mind what is happening. First we are drawing the initial points, the equilibrium points we are drawing, then we are actually drawing this SSC T. What is this SSC T? Because of the imposition of excise tax, the SSC curves are shifting upwards. SSC curve is shifting upward. This is the SSC T. So from here we will get, from the minimum point we get another SMC. This is SMC T. We get the another minimum point SMC T. Next, what happens? So this is the equilibrium position. I can tell it as PT, and this will be continuing from here also, isn't it? We will leave it like that. Leave it like that. Now, because over here you need to give the reason for each and every step, isn't it? So now you see the demand curve is downward sloping. Okay. Now in this point, now the SSC curve is here. So the firm is lying below the SSC curve. Pure economic loss. The firm is earning pure economic loss. So now what will happen is that, because the demand curve is downward sloping, there has been increase in tax. So price will increase, but not equal to the rate of increase in tax. Okay, so price will increase but not equal to the rate of increase in tax. Did you get it? So tax has been increased by this much, so price will, in short run, do not forget to mention, in short run price will increase but not equal to the rate of tax, because here the demand curve is downward sloping. If the demand curve was vertical sloping, then the increase in price would have been equal to the rate of increase in the rate of interest. Got it? So here what will be the price? Suppose it has increased to here, this much only. So we get another point like this. Okay, so this is my equilibrium point, new equilibrium point with the demand. So my supply curve will be passing from here. This is also for S1. This is actually supply curve S1, but for N not number of firms. Number of firms are still the same. Why number of firms are still the same? Because here you see the output has fallen. Output is fallen. See here the equilibrium SMC, with SMC the output is fallen, Q1. Okay, so this is P star. The output is falling. Okay, and overall the N naught is the number of firms in the market is same in the short run. So the total output of the industry is also falling. In the long run, what will happen? Here also the firms are incurring economic losses. So definitely many of the firms will leave the market. Okay, as many of the firms will leave the market. Now how many firms we have? We have this N1 number of firms, which is actually less than N0, right? And this N1 number of firms will be producing the same amount of output, What output? Q0 output. So N1 firms produces Q0 output. Okay, the initial output level they will be producing. So now what is happening? We will be returning to the same output level, and in the same output level the price is PT, which is over here we will drawing the equilibrium position, and this is the equilibrium. Okay, so here this is the supply curve S1, but for N1 number of firms. Okay, so this is another equilibrium which we get, and this one will be N1 Q0. So overall you can see in the market, in the industry, the overall output is actually falling. Okay, in the long run as well as in the short run. But in the firm, in the short run the output is falling. In the long run the output is again coming to the initial position, that is Q0. But overall you get this effect where it is actually keeping on falling. Okay, as we impose the excise tax. So this was all about excise tax. I hope you like this video. Thank you.